Hi, I'm joined by Laird Landmann, who is the co-director of fixed income at TCW. Laird, very interesting times in the fixed income market right now. Lots of opportunity for people who are not Newport Beach based. My colleague John Gapper was writing in Thursday's paper about the cult of star managers. And how the value that star managers bring to an organization might be, they might be exaggerating it in their own head. What's your view of the cult of stars, and how do you play things at TCW?
Well, I think we've always taken the approach that while that's a very attractive narrative, that investors like to believe that they're investing with a star, with someone who has intuition or skills that go beyond what everyone else has. The truth is really process at the end of the day. A good investment process is what generates alpha for investors, and we've always tried to stick with that. And I think that when you have this intersection of personal vanity with a star and the notion of fiduciary responsibility, they don't go well together. And I think that really what investors need is teams of people who are doing a disciplined process to generate that alpha, and that there's redundancy, that they're not reliant on a star. They're reliant on really a firm that follows a good philosophy and process and has the empirical data, the empirical success to back that up.
Now, of course, there's no guarantee either way. Star managers and process-driven firms have each got the interest rates wrong this year. We've seen another leg downwards. What's your view of where interest rates and yields go from here?
Well, they just released the Fed minutes today, and clearly what the market is seeing is the lower for longer notion here. They're seeing that the Fed is using the strong dollar as a way to hide and suggest that they can have more latitude to be dovish for longer. And it's clearly priced in the market at this point. We take a much longer term view, and we have, with our process-based approach, we've been wrong this year. But I'm happy to say that if you limit the risk you take, if you have a good risk control process, you're able to weather the storm. And we're actually, despite being somewhat wrong on rates, we're still above the benchmark overall and above many of our competitors. So the process still can work even when it's out of favor for a period. And I think that long-term rates need to move higher in the U.S., and it may take 6 months, it may take a year, but eventually the Federal Reserve is going to get around to raising interest rates again.
And what's the speed with which they do that?
The speed's unknowable, and I think we would caution investors in general, don't listen to the Fed or don't listen to them too carefully, because they're talking their book like everybody else is talking their book. And they will adopt their process and how fast or slowly they raise rates to the data and the circumstances. There's no dots, magic dots, that are going to basically tell you what's going to happen in the marketplace. We went through the 1994 cycle. They kept telling us, oh, we're just adjusting things a little bit. Don't worry, it's just a quarter here and a quarter there. And eventually, obviously, when the data fit them, they raised rates rather dramatically, and it caused a number of disruptions in the markets, and a lot of bond investors lost a lot of money.
But how does your view of interest rates rising dovetail with your view of the competitiveness problem that's affecting growth in the U.S.?
Well, I think that the competitiveness problem is the long-term problem that we need to fix, and the Federal Reserve has been trying to fix it by stimulating demand. I guess if you're a hammer, everything looks like a nail, and if you're the Fed, every problem looks like monetary policy to you. But obviously these problems have to be solved most likely through other policy mechanisms over time to make us more competitive as a nation. And I don't think that the Federal Reserve can do that, and I don't think perpetually low interest rates are going to solve that problem.
And tell me finally just how big the scale of the opportunity from the problems that Pimco might be for TCW.
Well, it's hard to know, and we haven't changed anything about what we're doing day to day. We're striving to deliver alpha for our clients. The first thing we did when we saw the flows beginning to pick up into the mutual fund side is just meet with our specialists, discuss what their capacity was and how they felt about taking those flows in. Everyone right now feels that the opportunity set is strong enough that we can take those flows in, but we're going to monitor it carefully. We can clearly take in, potentially tens of billions of dollars over this part of the cycle, but a lot of that really depends on how our peers do and how the folks in Newport Beach work to alleviate the concerns that are in the market.
Laird, thanks very much.
Thank you very much.
This is Stephen Foley for the FT in New York.